5 days from tonight, one earnings report decides if the market just made a 40% mistake. Because this spring, Netflix was handed $2.8 billion for walking away from a deal, and the stock crashed anyway. So we convened the board, 5 of the greatest investors who ever lived. Their real documented methods run cold on the same numbers. Not hot takes, not financial advice, AI models of public methods. By the end, the board votes, steal or trap. And here's the twist. The legend you'd bet on to buy this dip is the one who refuses. The board convened in July 2026. Here's what they saw.
5 legendary methods, 1 crashed giant, a 5-day fuse. These are the numbers the legends saw in July 2026. It starts with the strangest comeback setup this board has ever been handed. Start with the paradox. The business did not shrink. Revenue grew, profit grew, the audience grew, but the stock collapsed anyway. When that happens, one side of the market is badly wrong. Which side? The damage first. From its high, the stock surrendered more than 40%. For a company this size, that is not a dip. It is a verdict, but a verdict on what? Because the machine behind the ticker looks nothing like a crisis. 325 million paying households, the largest subscription audience in television history, and fewer than half the homes that could pay it do, yet. Then there's the audience almost nobody prices in. The cheap ad tier now reaches 250 million viewers a month, a country-sized audience. 2 years ago, it barely existed. And that audience is turning into money. Ad revenue doubles this year toward $3 billion. The stated path, triple that by 2030. Keep this engine in mind. One legend's entire score hangs on it. The core engine still runs hot, roughly $51 billion guided this year. Growth of 12 to 14%, margins above 30, numbers most studios would kill for, and then it gets stranger. This spring, Netflix chased Warner Brothers Discovery. The price turned silly and Netflix walked. The breakup clause paid Netflix $2.8 billion. Free cash flow guidance jumped to $12.5 billion, paid billions to change its mind, and the stock kept falling. Why? 3 reasons, each one a landmine for a different legend tonight. First, the attention war. YouTube now takes 28% of American streaming time. Short-form video eats the youngest viewers hour by hour. This moat is being shot at from a direction. The crowd didn't walk, it bolted. One retail sentiment index fell from 82 to 28 in a week. The trigger, a viral claim that top shows lose most of their audience between seasons. Contested, but the exit was real. Third, the calendar. Netflix missed expectations in 2 of its last 4 reports. A miss costs this stock 10% in a day on average. The next report lands July 16th. Every method tonight scores with that grenade on the table. Now what the crash created. Netflix trades near 20 times next year's earnings. The cheapest this company has ever been offered. 15 years on the luxury shelf. Suddenly, the discount rack. That smell is what the greats call blood. But Wall Street cannot agree on what the discount means. Published targets run from 134 to 286. When professional opinion splits that wide, someone is about to be spectacularly wrong. And the ghost in the room, 2022. The last time Netflix crashed harder than this, it rose roughly 5-fold after, but hold that memory carefully. The method that caught that bottom sits at this table, and it's about to say something nobody expects. Where does real money stand? The company keeps buying back its own shares. Analysts still see roughly 50% upside. But retail, the crowd that rode this stock for a decade, has fled, professionals leaning in exactly as the crowd runs out. Time to seat the board. 5 frameworks rebuilt from their published methods, not the people, the methods. Each scores 0 to 10. The spread is tonight's real story. First chair, the arithmetic that has laughed at this company for 15 years. The Benjamin Graham model, margin of safety, the price must protect you even when the story fails. Since Netflix went public, this screen has thrown it out on the first filter. Tonight, for the first time in the company's life, the screen hesitates.
4 filters, a ceiling on the earnings multiple, price against real assets, a fortress balance sheet, unbroken dividends. At 20 times forward earnings, Netflix passes the first filter barely, and for the first time ever. Then the trouble starts. What stands behind the price? 12 times book value, the screen wants 1.5. The library is real, but it is spent and respent every year just to stay alive. No dividend ever, modest net debt. Sound, but no fortress.
The Graham score a 4, hear what that means. For 15 years this screen scored Netflix near 0. A 4 is the loudest compliment this arithmetic has ever paid the company, but a fair price is not a margin of safety. And the next chair, fair is all he ever needed. The Peter Lynch model, the mall walker who beat Wall Street by buying what ordinary people use. And here's tonight's open secret, there may be no company on earth more Lynch than this one. 325 million households don't research the product, they live with it.
Classify before you buy. What is Netflix now? A stalwart that still grows like a fast grower, earnings compounding in the high teens. The PEG test, 20 times earnings against that growth lands close to 1. 1 is fair. For this company, fair never happened before. The crayon test, people pay monthly to watch shows. The company sells their attention twice subscription then advertising. A child can draw it. And the method's favorite setup is exactly this. A story still growing that the crowd just stopped believing.
The Lynch score an 8, the highest mark this board has handed out all season to a stock in freefall. A 4 and an 8 from the same balance sheet. But before the next chair sits, you need to see why this exact fight is a rerun with the roles reversed. Rewind to 2022. Back then, the value methods called Netflix uninvestable at 60 times earnings. It was the traders who caught the bottom and rode it fivefold. Tonight the sides have swapped. The value men are warming up, the trader is backing away. Same company, same kind of crash, opposite verdicts. One of these camps is about to repeat history's mistake, and the next 3 chairs decide which. First, the man who buys research empires and holds them for 50 years. The Philip Fisher model, buy a research empire with decades of runway, let the years compound. Fisher never asks about this quarter's print, he asks how large the earnings are 10 years out, and on that question Netflix hides its best secret.
Run the scuttlebutt. In under 4 years, this company built an ad business from nothing to 250 million monthly viewers. A second product, invented inside the first. That is what a live research engine looks like, but the checklist finds a flaw. First, the runway. Fewer than 45% of addressable households pay yet. Management has depth. The founder handed power to 2 operators without a stumble. Now the flaw, the product must be rerun every year, hit by hit. An empire whose inventions expire.
The Fisher score a 7, decades of runway. A second engine firing, held back by a business that must outright the world forever. 3 chairs in, 4, 8, 7. The value camp leans yes, but now comes the man who caught the 2022 bottom, and tonight's twist. The Stanley Druckenmiller model, 30 years, not one losing year. Liquidity first, the 18-month picture second, and 1 iron gate amateurs forget, the chart must confirm. This is the method that buys crashed growth stories. If any chair backs the dip, it's this one. It does not.
Walk the gates. Liquidity, acceptable. The 18-month story, genuinely interesting advertising could re-rate this company. Then gate 3, the chart is broken. Lower highs, a crowd in retreat. Sentiment cut from 82 to 28 in a week. Price action does not confirm. The gate stays shut. And the calendar seals it. A binary print in 5 days. From a company that misses 1 report in 3 and pays 10% for it. The method never bets a thesis on a coin flip it can wait for. You don't catch the knife. You buy the turn, then you size it.
The Druckenmiller score a 3, not a verdict on the business, a verdict on the moment. Right story, wrong tape, avoidable coin flip. The board's gunslinger just holstered, 4, 8, 7, 3. 1 chair left and it belongs to the hardest grader alive. The Charlie Munger model, wonderful businesses. Fair prices, a lifelong allergy to stories. This chair has zeroed almost everything this season. It called the crowd's favorite AI name speculation in an investment's clothes. Whatever it says now decides the night.
4 questions, Circle of Competence, a subscription that sells attention inside it. The moat, 325 million households, a content budget rivals cannot match, an ad machine bolted on top. Rationality, here the model found its favorite evidence all season. Netflix wanted Warner Brothers Discovery. The price turned silly. Management walked away from its own headline and banked $2.8 billion for the discipline. Most empires overpay at exactly that moment. Walking away is the test. But one worry remains, a generation raised on 60-second videos.
The Munger score, a 7, a wonderful business at a fair price. The phrase "this method exists for" said about Netflix for the first time in its history. The swing vote lands with the Bulls, 5 scores down. Now watch the total, because the average is not the verdict. 4, 8, 7, 3, 7, the composite board score, 5.8 out of 10. The highest this board has awarded all season. The legend's cold arithmetic just called a crashing stock a fundamentally sound, but a different number should keep you up tonight. The spread, 5 full points, a 3 to an 8, and look where it breaks. This is not Bulls against Bears, 4 of 5 chairs endorse the business. The split is about time, what a thing is worth against when you're allowed to buy it. Graham, Lynch, Fisher, and Munger saw a discount. Druckenmiller saw a live grenade with a 5-day fuse. Here's the uncomfortable part, both can be right. They're answering different questions on different clocks. So mark what July 16th decides. 3 things. Does advertising stay on pace to double? Does engagement hold against the short-form flood? Does management defend the guide? Deliver all 3 and the trader's own method flips to a buy signal. Miss and the discount gets deeper and more honest. See the season's pattern? When the crowd rushed into the AI darlings, this board handed out zeros. Now the crowd stampedes out of a profitable giant and the board leans in. The methods keep voting against the crowd. That is the entire discipline.
So here's what the board would actually tell you. If you buy businesses 4 of 5 methods, just called this one sound, at the fairest price it has ever traded. If you trade tape, the one method that made fortunes on setups like this says, you don't catch knives, you buy turns. At these prices, the method's called Netflix a steal that hasn't stopped falling. July 16th decides which half of that sentence wins. These are AI models built from published principles. Not the people, not their quotes, not endorsed. Educational, not investment advice. Numbers as of July 2026. The methods are timeless, rerun them with today's. Now argue with the board. Which legend got it wrong? The trader at 3 or the teacher at 4? Tell me below and subscribe. Next, the legends take the stand on a company the whole market swears can't fall.